welcome my guests, Danny Kim, Head of Revenue at SFOX, and Neil Van Huis, Director of Sales and Institutional Trading at Blockfills. Hi, gentlemen. Thanks for joining us today.
Hey, Tiana. Thanks for having us.
Thank you.
Great. So we're going to talk a little bit about liquidity in crypto markets. Just to set the scene a little bit, the level of liquidity in any asset class is important, obviously, for any trader or investor. But liquidity, even in what are perceived to be the most liquid markets, can evaporate in an instance when an information deficit occurs. So, the flash crashes in global stock indexes in 2011 is a good case in point. So, given their relative short lifespan, crypto markets, especially the top few most dominant tokens, do seem relatively liquid, even when compared with many well-known traded traditional asset classes. So your firms have each been in the market for some time, and you both come from traditional backgrounds. So Danny, let's start with you. How do you think that the crypto spot markets compare to traditional markets, say, 3 to 5 years ago versus now? Have they grown in liquidity? And how has that growth, in fact, impacted businesses over this time?
Yeah, sure. So, when you compare to crypto markets to traditional markets, it's actually quite interesting, because if you look at the traditional markets, unless you're paying for services, you actually don't know the liquidity behind it, right? Like in crypto, because this was actually started by, engineers and people who focused on the computer science aspect, you actually have a lot more in-depth information available, right? You can actually see order book depth. You can see what the top bid and ask is. If you're trading on Fidelity or any other platform, all you really see is the top of the book price, and that's it. You don't really know exactly what's behind it. Yeah. And now you're kind of seeing where in crypto, like that market where transparency has been growing, it's expanding. Right now you're seeing more platforms out there trying to be even more transparent, where you could ultimately see what true liquidity is available. And from 3 to 5 years from before to now, liquidity has grown tremendously, right? What we've seen is that, heck, if you try to buy 100 Bitcoins in two to 3 years ago, you'd move the market instantly, right? Yeah. Yeah. I mean, you've seen multiple flash crashes every other day. But today, people will say it's, if you try to move Bitcoin or Ether, it's fully liquid. It's a lot more comfortable.
So, Neil, what are some of the challenges in accessing liquidity in the markets versus crypto markets versus traditional markets? So it sounds like we're going in the right direction, but it's obviously not perfect.
Yeah, absolutely. So, I mean, if you look at 2016 and forward in traditional markets, liquidity actually changed in a number of different asset classes. I was trading actively almost every major asset class in 2016. And when futures clearing merchant rulings with the CFTC changed on leverage and settlement, going from T+3 settlement down to T0, liquidity totally changed. And so I would say that in some traditional markets, liquidity has actually become more poor and has pushed participants out of the marketplace. Whereas in crypto, 3 to 5 years ago, the amount of firms that were really playing in the space was very small, and they were completely controlling the market. Today, I would say not much has changed from the ideology standpoint. There are still a lot of firms that control the market, but there's 4 to 5 times more players than there was 3 to 5 years ago. So that liquidity has expanded. There's been more traditional players that come in, bringing reputable balance sheets and reputable business practices into the space. And so I think today we've expanded quite a bit, and I would say 4 to 5 orders of magnitude greater than 3 to 5 years ago.
Yeah. So talking about that time improvement, trading has become very automated, and most of the leading crypto or the leading market makers are now getting into that crypto space. So without the same level of regulation that we see in other markets, we talk a lot about, are the order books really reflective of what's in there? Is the advertised liquidity real? Is it easy to fill these large orders? Is liquidity being manipulated in some way? So maybe each of you could give me a view on what you think, what your experience has been about how the order books are behaving.
Yeah, sure. I'll jump in. So that's the thing, right? So like, I think there's two parts of it. I think the conversation has always been more about, is the actual volume true or not, right? Is that
Right.
volume being manipulated versus, what's actually on the order books. On the order books, I would say, there are various different activities out there, but again, because of transparency, you can actually see what's available, right? And if someone is flashing orders, you can actually see that because you'll see 500 Bitcoins on one side, and then it'll immediately disappear and go back. So when I say when you're looking at like order book activity, you can actually see truly what's going on. Trading volume is where I think it's a little bit different because you don't know exactly who's actually trading on that side or not.
Mm-hmm.
Now, with that, I would say that I think that the order books in generally have improved a lot. Spreads have drastically improved over the years. Each exchange across the market, you could see that they have tightened. Depth has increased significantly as well. And along with that, it's, if you generally, I think if you compared it to, say 2-3 years ago, there were constant arbitrage opportunities because order
Mm-hmm.
books just didn't have enough liquidity, right?
Mm-hmm.
And that sophistication just wasn't there. Now you've seen that the arbitrage opportunities, especially for the top two coins of Bitcoin and Ether, have gone down significantly. And the reason being is, going back to the last question of it's being able to access liquidity better. The exchanges have been able to facilitate, and OTC providers have been able to facilitate better liquidity for other markets to enter. And then as well as the exchanges have been able to support these and build these infrastructures where they could build a stronger order book.
Mm-hmm.
But I think that, I think the question of volume, is it real or not? I think that's always up for discussion. But yeah, that's kind of what I see right now.
Neil?
Yeah, so I think, one of your previous questions was what kind of challenges are there to accessing liquidity? I think if you take a look at this space relative to the traditional markets, you've got, an incredible amount of trading venues in which you can choose from to access liquidity.
Yeah.
Whereas in traditional markets, you might access CME Group, NYSE, ICE, etc. There's one traditional product, one flagship product in the world, and everyone's trading it on one exchange, right? So accessing liquidity comes with a lot of different choices, right? And so now, we kind of approach liquidity slightly different. We consider ourselves an organic source of liquidity because we don't source any liquidity from exchanges. So although market makers who do business with us directly do business on other venues, we are in complete control over our liquidity selection because we have market makers writing into us directly, or we write into a market maker's API that they provide to us. So when we aggregate a feed and we disseminate that feed out to our client base, a couple of things occur. One is market makers or high frequency traders are not allowed to trade against themselves. And so what we do is we submit orders and check order sizes and check order execution availability with each market maker algorithmically as we push an order to the market. And so by doing that, number one, you reduce slippage because they either accept the order or don't accept the order. And if they do, it's filled. If they don't, we route it to the next available order of that size or greater. And so when we disseminate this order feed to our clients, we don't have any market makers constantly hitting each other over the head to try to decide where the market is. You've just got a book that you can execute against.
Yeah.
So we have very low slippage, very reliable executable quotes without high frequency always trying to decide where they want to be in the book. So that's number one. Number two is all of the orders that are placed in our ecosystem are anonymous. And so when you put 100 lot on the bid to buy at 9,300, no one knows that order is there. And when the market makers come down and cross it, they don't know what the size of that order is. They're just moving their quotes to where they're willing to do business. And if it's crossing our order, it's filled.
So let's move over to the derivative space. So we've seen an explosion of growth in the unregulated crypto derivatives markets and the emergence of products such as perpetual swaps, enabling people to trade pretty significant leverage Excuse me. So how real is that advertised liquidity? And with the growth of CME futures, for example, how interconnected are the regulated and unregulated markets in the derivative space?
Yeah, sure. I guess I'll start. I think that it's an interesting landscape. We don't work with any retail folks, so our look into the landscape, I think, is very one-sided.
Okay.
When we talk to professional traders, hedge funds, institutional traders, et cetera, they really tell us, yeah, we're not really looking for another perp out there in the world. We're not interested in 100 times leverage to take a position. We're just market making. And so I think if you look at those highly levered positions, the demand is on the retail level or on the low level professional that is looking to try to outperform. If you look at what the majority of institutions we work with in the space, they're very happy with a CME product. They're very happy with a product like CME's product. So from a regulatory standpoint, we have an unregulated platform. We have a regulated platform through our FCA regulated broker dealer in London. What we're trying to bring to market is something that looks a lot like a traditional product, that acts like a traditional product, that has traditional clearing mechanisms and margin protocols in place that are not just blowing people out. And I think that the best point I can make on the side of liquidity in the traditional perpetual swaps is liquidity is real until it's not. And that's basically all I can really say about that product is they're making markets very happily and it's very liquid until they get to a point where they see the market extraordinarily one-sided. And at any given time, a spot market or a derivatives market can lead the market. And the reason for that, in my opinion, is because we don't have one core exchange, one core product like we do in more traditional markets. At any time, a massive order could take place on one exchange where people are reacting to on various other exchanges.
Let's shift a little bit to DeFi. So DeFi has become all the rage. Platforms like Synthetics claim on their website to provide infinite liquidity. The balancer automated liquidity pool got hacked. Traders are being incentivized to provide liquidity via token rewards, for example, through Compound, and potentially illiquid tokens on one network are being locked up as collateral on another network. So is this a good thing or a bad thing or an accident waiting to happen?
Yeah, I'll jump in. I mean, just going back to what Neil said, like, I think it works until it doesn't work, right? And we've seen, like, I think DeFi right now is becoming very, very popular. It's a thing where, everyone believes in and wants to get into. And that liquidity, it's good, it's there, but it's still very early, right? You don't, like, it's like everything that starts off as a new product. The idea is always great, but there are always still certain flaws that need to be, checked out. And unfortunately, there will be accidents that do happen.
So Neil, do you think, liquidity providers get paid to make markets on traditional exchanges? Is this just a programmatic equivalent?
Yeah, I think you could kind of look at it that way. And there's an old saying for those of us from capital markets, liquidity begets liquidity. And so I think that's kind of what you have here is, as long as there's liquidity, more liquidity will come. And so it is, I think, a little bit of a programmatic description of that. One thing I would just say is that, DeFi, while I think inherently it's an incredible idea, incredible concept to build for the future, what we see in more traditional markets is only certain players have certain access to certain products, right? And today in DeFi, I think that opens that up completely. Yeah. What we'll find along the way is things like we saw in crypto early days were accidents, where certain players don't understand certain products, which is why traditional markets tries to protect people from certain products. You'll find that people will get hurt. People will not understand things. There will be security measures because of oversubscription and mass adoption. And I think that's the thing that I dislike most about DeFi right now is platforms that try to grow too fast, too early, and don't have the right security in place. It's one thing to get hurt on a trade. I know that all too well. I'm a trader. I take risk for a living. It's one thing to get hurt on a trade. It's another thing to get hurt from not having the right technology and security in place. So our hope is that while DeFi is very immature, we hope that it expands. It has a ways to go, in our opinion. And we're trying to bring liquidity to yield enhancement strategies through our structured product division in a slightly different way, which is a little more centralized, a little more institutional, which is where we sit. But DeFi can certainly bring a lot more to the broader market.
Well, we'll see. Still very early in the DeFi space, I think. Danny, Neil, thank you both so much for joining us today. It was a real pleasure.
Thank
for
you.
having us.